we are prepared for referred to as catastrophic loss situation, something unforeseen entirely in of itself. For example, unfortunately, 9/11 in the United States,
right.
when you had the World Trade Centers collapse and surrounding properties, tremendous losses there. And unfortunately, it also, not only was it a large property loss, large human loss, a large loss to the nation, but the reality is a lot of folks were at work.
Mm-hmm.
And it was a workers' compensation issue.
Welcome to The Defense Never Rests with Morgan and Akins, your monthly dose of uncommon sense about all things legal and some that are not.
Hi, everyone. Welcome to this episode of The Defense Never Rests. I am your host, Megan Henry, and I am joined by my co-host, Nate Bolander. Hi, Nate.
Good morning. How are you?
I'm great. Welcome back. It's been a while.
I know. I'm going to be regular now.
I think the last time I had you on, it was our burning questions episode, so I was worried you'd never come back.
Yeah, I thought you said you wanted me to do volume 2, and I agreed. So I obviously am not so scared off.
Yeah. So preview, we're going to do another one, everyone.
And I'm going to get a lot deeper with my questions. I'm not letting you off the hook again.
I know I'm a little scared, but that's not what we're doing today. So today we have on David Corey, who is a senior VP at Argo Group. And he is coming in to talk a lot about underwriting, because it's simply something I don't totally understand, but I know how important it is on the insurance industry. So I thought it would be, an interesting topic to talk about today.
Yeah, we deal mostly with the claim side of things, and this is way behind the scenes, and it'd be interesting to pull back the curtain and get a view into that part of the industry.
Yeah, absolutely agree. So with that, let's bring him in. Good morning, David. So happy to have you join us this morning on The Defense Never Rests. How are you this morning?
I'm well, thank you.
And Nate is co-hosting with me today. I always love to have Nate on. He adds a nice some good funny zingers to the podcast.
We'll see if they're muted today, given my allergies, but I'll try my best.
So for our listeners who don't know, you are a senior VP at Argo Group. But, I'm always interested to hear whenever I have anyone on that is in insurance about your career path and how you got there. Because a lot of us, don't graduate college and say, hey, I'm going to go, work in insurance, and everyone's path is a little different. So I'm curious to see how you ended up where you are today.
Well, I hate to be the first, but I am the first. I did, when I was in school, decided to go into insurance. So, yeah. So my grandfather was an insurance agent. Took kind of a personal lines insurance agent, had it out of his house, kind of a thing. So I got as a kid, kind of exposure to that, and folks coming over to his house and renewing their homeowners and auto insurance. So I remember those days. But no, I got into school. So I attended the University of Cincinnati, and I was a finance major. And as I got more into my junior year, I had lots of friends that their career path, this was the early 80s, were going to go into banking, commercial lending, and the explosion of mutual funds, all that kind of started at that time, really, I think. And so I just felt like working at a big bank was not going to be attractive to me. I kind of wanted to really focus. I always thought that was important to focus and be more lasered in what I did. And so I leaned towards insurance, and I felt like, if you went, out of 20 finance grads that I knew, I was the only one going in insurance. And I thought, well, maybe this is a better career path for me, more opportunity. And so I actually picked up a double major. So I actually was able to, at that time, the business school offered a major in insurance, actuarial science and insurance. So I double majored in finance and insurance, and decided to work for a carrier. I was graduated, and I was gone for about a year with the National Guard, going to officer school when I got back. And sure enough, I had a friend of mine that I knew that was working in an insurance company, and he called me out of the blue, and he said, they're looking for claims or underwriting. When do you want to come out and interview? And I thought, well, okay. So I said, is the claims inside claims or outside claims? Because I didn't want to be at a desk handling claims all day. He said, oh, it's inside claims. I said, well, I'll go underwriting. So that's kind of how I got into it. So I went out and interviewed with several people. They offered me a job right away and got into underwriting.
And when we had talked a week or so ago, and you've been in the industry for 30 years. And
35 years. I hate to say it. 35.
Well, no, you love to say you wanted to do this.
Yeah,
This is the path you've chosen. But how have you seen the insurance industry evolve over the time?
Oh, it's dramatic. On the carrier side and the broker side, dramatic. The distribution channels have changed dramatically, and the carrier side has changed dramatically. When I first started my career, I had actually started in the city of Cincinnati, which I would say is probably a tier 2 city in the U.S. And there were over 24 insurance companies that had branch operations in the size of a city like Cincinnati. Through the 80s, what you saw is just rapid mergers and acquisitions on the carrier side. And if I was to take a pad of paper and write down from A to Z those 25 insurance companies that had branch offices in Cincinnati, half of those companies are not even in existence today. They got acquired by competitors. And then 23 out of the 25 don't even have offices in a city like Cincinnati anymore. So what you've seen is consolidation. You've seen carriers through the use of technology, which is a whole separate conversation, being able to regionalize their operations. And so that's kind of one of the reasons why in my career I moved into Chicago about 11 years ago to relocate for a job that I moved into that was a national job. So it was two things. I could have done that job from any office at that time in the company, but I chose Chicago because what I saw here in the Midwest was the Chicago's got bigger. So if you look at the insurance industry, the New York market, maybe a little bit of Philadelphia, you go down the coast, it's really morphs into Atlanta, Chicago, Dallas, Houston, and in California, it's really Houston Los Angeles and San Francisco, and to some degree Denver. So companies, all the carriers have decided really to kind of go to more of a hub and spoke system. So they have bigger regional offices in larger cities in the U.S. And then when they typically have if they have branch offices, it's smaller or it's production staff in other cities. And then the second part of that is technology, of course. When I first started in 1986 working a desk, I did not even have a personal computer, right? So you didn't have them. There were a couple, 3 of these quote unquote dumb terminals, if for those folks that may be aware of those, but they were basically IBM computers that you would sit down and click on and you could research and find something, but there was not an interactive desktop computer.
You probably had to put a disc in too, like a little
floppy disk. Mm-hmm. And there was a telex machine, and I'm sure people don't even know what the heck a telex machine was. But I remember when the first fax machine came in. It was around 87.
Yeah.
I was going to ask, do you think that the technology has made insurance less personal because you grew up watching someone in your own household renew policies with a handshake and meet people face to face, and then now you're talking about moving from telex to fax to now personal computers, and people can do remote claims now and things like that.
Or you don't even need to talk to a person.
Of course not. Yeah, exactly. I remember I got a fender bender about 5 years ago, and Geico said, send pictures of the accident. I did, and the police report, and they said, here's your rental car. I didn't speak to a single human being other than a chat on my phone. So do you think that's helped or hurt the industry? I know it's more productive per se, but is it better?
I would say it depends on the side of the whether it's personal lines, commercial lines, or specialty lines. There's still a tremendous amount of business that has to be conducted one-on-one. If you look at the personal lines, clearly, I think the direct writers, if you will, the insurance companies that can write insurance without going through a licensed insurance agent or broker. Those would be like your State Farms, your Allstates, your Nationwides type companies. They can go direct consumer, and there's others. They're probably the ones that kind of evolved to an app and kind of the process you just described, because it was kind of part of their DNA and how they were set up as an organization. Other carriers have kind of gone that way. Some carriers have chosen not to do that because they want to utilize the independent insurance agent and broker network, insurance broker network, and they don't want to infringe upon that distribution channel. When you get into the commercial lines, there are commercial lines available through apps and online, and small business owners can go on and use websites. But there's still a tremendous amount of insurance that is placed. I would even say like certainly the Fortune 5s, but even if you go down, let's say Fortune 1000s in that range, they really need, for a vast majority of their insurance, they have to interact with an insurance agent or broker. The Fortune 5s, most of those firms have a risk manager in place, someone whose position is to advise typically the CFO, the treasury manager on insurance purchases, and advise overall risk management exposures of the company from across the whole spectrum of property, casualty, and specialty insurance. And depending upon the company, they may have the larger Fortune 5s. They may have, aviation exposure. They may have a marine exposure, so they buy policies to protect their vessels. So that kind of complex risk is very difficult to do through simply an app on its own.
Yeah, I mean, I think the difference is maybe towards the personal lines versus like larger commercial lines for companies. I think, if you're getting homeowners insurance or car insurance, I think you probably the personal part is kind of taken out of the equation now. But of course, for like those much larger transactions, it's much more complex.
It is, and it also depends on the personal lines exposure too. I mean, the ultra wealthy, the high net worth, it's usually they refer to as high net worth individuals. Those folks that have multiple homes, high valued homes, they have high valued automobile schedules. They have perhaps vacation homes that is coastal exposed, and or yachts, large vessels, art collections. You'll see that segment. I'll continue to work with a broker who understands that exposure, can place it for them.
Yeah, I'm not one of them. And I don't know many of them, or I don't think I know any of them.
In my career, I've actually seen customers that spend $300,000-$400,000 a year on personal lines premiums.
Well, I can understand that if you have multiple homes, you have artwork, maybe you have a personal, jet, you might have a yacht. Yeah, you're going to spend that much because you have a lot to insure. You have a lot to protect. Right. And, you might be insuring your legs. I mean, who knows what you're insuring?
Yeah, we had a Lloyd's of London representative on the podcast who said that David Beckham insures his legs and Marilyn Monroe insures. I mean, the people insure body parts all the time.
Yeah. Yeah.
When it's part of your livelihood, then you need to do that, I think. Yep. So your whole career, you've been in underwriting, and we're kind of here a little bit to talk about underwriting because, for some people like maybe Nate and I and others, underwriting is like an enigma to us. And I understand it's like the backbone of the insurance industry, but a lot of us don't really understand the ins and outs and how it actually works and how you go in to assess the overall risk of your insured to be able to, develop a policy for them. So, I mean, I guess in kindergarten type terms, can you explain how the underwriting process works?
Well, sure. I always, and this is my personal view, from an insurance carrier's perspective, if you think about it, you have is running a business. So in the very basic business 101, you have, any company, you have dollars in and dollars out, right? So you have revenue that comes in the organization and you have revenue that goes out. For an insurance company, that happens to be premium. Premium is our revenue in, and claims expense is our dollars out. And of course, we have other expenses besides claims, but our largest is our claims. What the position of the underwriter is for the organization is they are the professional risk taker. They are the ones that are accountable for the new business and the renewal business that the carrier writes. So I always felt like underwriting was more critical, at least in my opinion, and I'm biased, for businesses and for our economy to hum and go along. I use the banking as an example. Friends of mine that got into commercial banking. Now I know there's exceptions to this, and I know in the 08-09 financial crisis, clearly the banks took financial risk and lost billions and trillions of dollars on bad loans. But fundamentally, a commercial banker shouldn't take a loss. They should underwrite and they protect themselves. And one of the way they protect themselves, for example, is they require insurance on what they're lending money on. Or if you look at a commercial banker, even in your home, you have to buy homeowners insurance, and that's to protect the loan, right? That's to protect the value of the home in case it does unfortunately burn to the ground. At the bank, there is insurance there. Same in commercial lines insurance. So the job of the very basic job of the underwriter, regardless of what line of insurance it is, whether it's a property coverage, whether it's a casualty coverage, whether it's a specialty line, like for example, directors and officers insurance, the job of the underwriter is to be very knowledgeable in that line of insurance, learn the exposures associated with assuming the risk, be very proficient in the policy form that's covering that risk, and then ultimately determine a premium that's acceptable with weighing the exposures and buying that business for the company.
And in a way, I kind of, and now that you've explained it, look at it a little bit like taxes. Like at the end of the year, you really want your taxes to be even. You don't want to owe, and you don't want a huge return, because you want to pay in, during the year what you owe. Is that a on point analogy to that?
Well, it depends on the company, and it depends if you're publicly traded.
Mm-hmm.
The companies that are publicly traded, the insurance carriers that are publicly traded, I should say, require so I think what you're referring to is, let me just back up, is what's referred to in the industry as the combined ratio. The combined ratio is the combination of the claim expense and the company's expense of operating the company. So it's our underwriting, referred to as the underwriting expense. Those two numbers added together, the claim expense and the underwriting expense, if it's at 1 or 100 is a combined ratio, it basically means that for every dollar of premium you're taking in, you're paying out $1. Mm-hmm. In the past, in the industry, depending upon where interest rates were and depending upon the insurance company's balance sheet and where they had their investments, that might have been sufficient. The last decade, that has not been sufficient. You cannot return your return on equity, your ROE requirements at 100% combined ratio. And most public companies try to achieve like a 15% ROE, meaning that their equity, the shareholders' equity in the company, that they want to return as a target, maybe a 15% ROE on that every year. When interest rates are dramatically low, in the property and casualty insurance business, they cannot typically invest in equities. They're investing in treasury, commercial bonds, high grade bonds. And so when those rates are very low, the 30-year bond, I mean, look at even today what the 30-year bond is yielding.
Right.
It was last year, it was less than a point. So you think about you're investing money for 30 years and you're going to get less than 1% interest on it. So that's ticked up now to, I don't know what the 30 years going for today, but it was 140, 130, something like that. But the point is this, is that the balance sheet, the investment assets of that company is not generating sufficient returns to run a 100% combined ratio to achieve the 15% ROE. So today, I would say, generally speaking, this is a general comment, that most companies are targeting somewhere in the high 80s, 80, 86, 87, 88 is a combined ratio. Sometimes it depends on the cat issue, it depends on unforeseen circumstances like COVID-19 that drove tremendous losses into the insurance industry. Now, if you're a mutual company, that's a different conversation because there's not sure, it's run as a mutual, it's a different financial model.
Now, I'm glad you mentioned COVID, because that was actually the next thing I was gonna ask. Like, you have something like COVID that I mean, I don't think anyone really anticipated it happen and at the magnitude it did. And I mean, the ripple effect and the impact on that on the insurance industry was huge. So, how does that factor in when you've done all this work with the underwriting and you think you've assessed a company's risk and something like, this pandemic happens?
Well, that's why my earlier comment, I feel as though in the insurance industry is vital, extremely vital to the operation of economies around the world. And so the insurance industry is a backstop. We have reserves. We are prepared for referred to as catastrophic loss situations, whether that's natural disasters such as wind, like hurricanes, hurricane wind or tornado. It's massive flooding, which again could be hurricanes, or flooding from heavy storms, heavy rain, or it's something unforeseen entirely of itself. For example, unfortunately, 9/11 in the United States,
right,
when you had the World Trade Centers collapse and surrounding properties. Tremendous losses there. And unfortunately, it also, not only was it a large property loss, large human loss, a large loss to the nation, but the reality is a lot of folks were at work. And it was a workers' compensation issue. And I remember one company in particular that I won't name, but it was a bond trading company, and I believe they lost almost the entire their staff in New York City. And so the insurance industry stepped up almost immediately the next day and stated, and I remember one carrier in particular stated that they were not going to invoke the war clause exclusion in the policy for 9/11, and they would step up and pay those workers' compensation claims. And so other carriers followed suit and did the same thing. And so that's what the industry is about. It's about spreading risk. And as an industry, they're able to sustain these large losses.
And so when you move forward now from COVID, how does your job change as an underwriter? So, obviously that we were not prepared for that. How do we prepare for it in the future from an underwriting perspective?
Yeah, good question. One of the things the industry the carrier side tries to do is learn from past events. So although COVID hit the industry, that was not the first time there was a viral issue. Viruses and SARS was one that had happened before, and there were others. So some companies had exclusions for communicable disease. They had, it depends on how they worded their exclusions, but there were some exclusions in property casualty policies for communicable disease exclusions or virus type exclusions based upon prior events that have happened. And now you're seeing some of that litigated now with the policyholders seeking business interruption coverage on their property casualty policies, mostly the property policies, alleging that they're entitled, or at least they have submitted a business interruption claim. And on the carrier side, the carrier's argument is that's not a covered peril. That being told to close for example, your restaurant, if the city or state that you're located in required you to close your restaurant for 6 months or 9 months, that's not a covered property peril loss. It's not like a fire, vandalism, windstorm, etc. Now, some policies did not have those exclusions. Some carriers didn't use them. And there was a lot of insurance that didn't have those that did anticipate, if you will. I shouldn't say anticipated COVID, but there's some insurance, for example, event cancellation insurance, which is available. If you go to a Broadway show, if you see like if you go to the movies, that movie's being produced and being in production, a live concert, a music concert. A lot of those events, entertainment, if you will, have what's called event cancellation, and there are, like all insurance policies, there's an insurance agreement and there's coverages and definitions of what's covered. Vast majority, I think, of those policies do not have a communicable disease type exclusion, nor would it be applicable because it's a broad-based type policy. The event has been canceled. It could have been from a variety of reasons, but the event didn't go on. Could be the performer was ill. It could have been there was a fire at the facility. There could have been, so the industry did step up, and the carriers that offered those type of coverages did, obviously receive those claims, and if they felt they were covered claims, they paid according to the policy.
Now, when Nate and I work on the other side with claims, and how do large claim losses affect the underwriting process for future premiums and renewals?
Right. Well, I would answer it two ways, potentially two ways. So you may have a one-time single event that's quote unquote in your words, a large loss or shock loss. For example, you may have a single location property. Like there was an example this week. There was a large fire at a facility in Illinois that is a chemical. Well, I guess it was a chemical manufacturing facility, and the building burned to the ground. There was an explosion. Luckily, all the employees were able to get out of the facility. Heavy smoke and fire, and it burnt entirely to the ground. Now, I don't perceive to know what the property value was on that building, but let's say it's $100 million building, and that would be a total loss. So that's one situation. The other one you get into, like for example, a named storm. So let's say we're coming into the hurricane season now, right? In the summer, and if a hurricane hits a particular area and widespread property losses, those type of claims are typically go into what's called a CAT unit, the catastrophe unit for the insurance company. So what the carrier typically does is they funnel those claims and they code those claims for, let's say, a named storm hurricane. They would, behind the scenes, they would assign that to their CAT unit. They have individuals who are experienced, have been there, done that, and worked catastrophe losses. And they engage they may have to engage all their claim adjusters across the country. For example, let's pick Florida. So let's say it hits the state of Florida. So typically a carrier may have adjusters who typically handle that territory. Well, the sheer size of the number of claims are going to be such that they may get claim adjusters come in from the western states up in the Northeast to come down in the Midwest to help out Florida. Again, all those claims would typically would run up, and the carrier would code those as CAT losses. I'm using the word CAT, and they would account for that from their premium, from their accounting perspective. Mm-hmm. They would typically roll that up as a total, and then if they're publicly traded, depends upon the time frame, but they would probably make an earnings announcement coming up to quarter close, an estimate to the shareholders what they anticipate the CAT loss total would be. They would probably also engage their reinsurance unit because they buy reinsurance typically for CAT type losses. Yeah. And so they would be engaged with their reinsurers through this whole process.
But what about the situations when we have these have nuclear verdicts and, the situations that you can assess, Nate and I do everything that we can. We say, we do the jury verdict research, we assess the damages, and we say, this is your potential exposure. And then you take it to trial and, you get hit with a $10 million verdict or whatever. I mean, what's the impact of that?
Well, the impact is that's been happening for a number of years in a number of jurisdictions. It happens. Well, number one is to talk about the financial side. So the financial side of that, carriers have reinsurance treaties. So either they may particularly buy facultative reinsurance, which facultative reinsurance is an individual reinsurance purchase on an individual policy. The other way of handling that is most typically handled in a treaty reinsurance arrangement, which is usually a 1-year period of time. And the insurance company has a reinsurance unit, usually at the home office or corporate level, that negotiates reinsurance on the entire portfolio, whether it's a property portfolio it's a casualty portfolio, or it's specialty lines, like, for example, directors and officers type coverages. And depending upon the insurance company, those treaties kick in at a certain amount. And there's I don't want to get too much into the reinsurance, but there would be probably a reinsurance trigger.
Mhm.
So, but the carrier would have to bear the whole 10 million. And ultimately, if it's settled, and if the carrier doesn't appeal it, and ultimately it is indeed a $10 million example that you cited, once that's settled, the carrier who's been advising probably their treaty reinsurers all through this process would then seek reimbursement, whatever that percentage would be from the reinsurers. That's that particular claims transaction. The big brunt of that claim still is going to be handled by the primary insurance company. The impact of that over a period of time on a number of claims is that, as has happened over the years, the insurance companies, when they negotiate their treaties, the treaty reinsurers, they want to make money too, right? So they're looking at these verdicts, and they may decide, let's say they were in that first 10 million, they were taking 60% of that 10 million. If you had that shock loss, now they might say, we only want 40% of that first 10. We want to move up. We think verdicts are going up too much, and we want either more of your premium or a higher attachment point.
Yeah.
The other situation you're faced with the reinsurers is that they can be very topical. I would say this calendar year, as companies' treaties have come up for casualty treaties have come up for renewal, the reinsurers are very focused on municipality business, for example, and specifically police liability.
Yeah.
Are you writing liability? Well, I shouldn't say the police department, municipal business.
Right.
Typically, the liability policies would be for a city, a county, a township. And so with the issues that are going on with the police and the public, and settlements, et cetera, that they're very laser focused on asking the carriers, do you write liability policies for municipalities?
Mm-hmm.
Is the police department included in that, et cetera, et cetera. So it's an individual risk issue, and then over a period of time, it's a trend. And as the trend goes up on the larger verdicts, it impacts perhaps even the decision to even write the insurance in that particular either line of insurance or geographically.
Yeah, I know you're not on the ground doing the claims handling per se, but internal conversations amongst insurance folks, is it leading, you think, to more not risking going to a jury, right? Settling the case, resolving the case before that? Is there kind of are people scared to, in a really liberal, really urban, usually jurisdiction, take it to trial because you might get hit with that?
Oh, absolutely. I can't speak for our claims professionals, but they are extremely knowledgeable of that issue and work with our panel counsel, our inside house counsel, and that are assigned to particular cases. And if the advisement is that we do not want to go to jury trial on this case, that certainly impacts the decisions to try to negotiate.
Yeah, I mean, we see it all the time on our end. I mean, what venues you don't really want to go to trial on, or at least you're very careful of what you assess. And I mean, there's Philadelphia and Miami-Dade County, and like there's certain counties that you're just like, this night might not be the one we want to tee up right now and put the risk on the table.
Right. I think that's prudent, and I think obviously that's why that's why we engage panel counsel. That's why we have in-house counsel, and I'm sure all of us do due diligence in looking at prior verdicts, prior decisions, prior settlements, similar circumstances, and making a decision on whether or not it's to press it and try to go in front of a judge or a jury, or just try to negotiate a settlement.
I mean, I do think the challenge with any evaluation of prior verdicts and when you do the jury verdict research is there always is that element of you just don't know. I mean, you could look at every verdict, in that venue for the same exact injuries, and they can all be trending one way, and sometimes you just don't know what your particular jury is going to do. So there's always like a risk. There's always a risk on the table, even in a conservative venue. There is a risk on the table. You don't know what that group of 8 or 12 individuals are going to focus on, and what they're going to take away from it. So it's I would say it's a science with some art mixed in with it.
And it's interesting as you say that, because I would say I would agree with you 100%. And I would also say that over the years that I've learned is claimants come in all shapes, sizes, and colors too, right? So meaning, someone who's injured who's 25 is different than somebody who's injured who is 65.
Sure.
Someone who is injured, let's say, and is married and has 4 children, comes into that situation different than, let's say, someone who's single and 30.
Right.
Someone who's contributed to the situation, perhaps. Maybe there's partial negligence on the claimant that can be proven clearly, or perhaps there was, we believe, partial negligence, but it's going to be very difficult to prove it. So all claims are different. All people are different. You'll see that in workers' compensation, for example. A young person, let's say someone in their 20s, might slip and fall and bounce back up off the floor and dust it off and go right back at work. Same person who's in their mid 50s falls, and then it's a broken hip, or it's a back injury, and it's a partial permanent situation for a while.
Yeah.
And the thing that I'm learning more and more over time, and it seems to be almost worse now, is the interplay between the claimant or plaintiff and then their counsel. I have some cases where the plaintiff's counsel, claimant's counsel completely controls the situation, keeps the person's expectations in check. It explains things as the case goes along. And I have other cases. I've been involved in one recently where they made a procedural decision, a strategic decision. I called the attorney and they said, well, I didn't want to do this, but my client made me. I said, this is a mate, and I get that they control. I understand that ethically they have to call the big time shots, but the interplay between a client and a plaintiff or claims attorney is really underrated, I think, in terms of how the case goes.
Right. I think that's what I was kind of suggesting earlier about claimants come in all different types, and you're right. You might have someone who is very, litigious as an individual.
Right.
They might have a personal experience where maybe in their family they've had prior situation or litigation, or they may themselves be a litigant many times. And so, they come in at maybe perhaps a more hostile, if I could use that word, approach than an attorney who's been there, done that, very experienced, and just kind of wants to settle this and move on.
Yeah, and I think a lot of times claimants can feel very wronged, and they want their wrong to be right, and they need counsel to be like, I understand your frustration and that you want to be right, but we have to rein it in. Like, I know you want the moon and the stars, but you probably can only have the clouds. They just need someone to kind of temper their expectations a little bit. So when in your position, if you're looking to add, someone to your team, an underwriter to your team, like what qualities are you looking for in an individual that would excel in this aspect of the insurance industry?
Well, I always lean on first probably the ability to be technical in what they do. My specific niche right now in the industry is environmental insurance. That's what I manage for the company I work for. And I have staff that report to me that are across the United States, from New York out to California and in between. So what you try to find is, and someone doesn't have to be an expert in environmental per se, but it does help. So for example, we insure environmental risk, meaning companies that have potentially environmental liabilities associated with their business operations, whether that's chemicals they work with, solvents, paints. It could be a prior issue where they contaminate the soil or groundwater they're in. So there are individuals who are experienced from a technical perspective. They may have went to school is a geologist. They're a trained geologist, and they understand soil, ground, rocks, and they maybe went post college. They worked as a environmental consultant and worked in the field and done some field work, or perhaps they are undergrad degrees in chemistry, and they're have very strong knowledge of chemicals, and that's helpful. I have some folks that work with me that have those backgrounds. I have other folks who work that do not. So it is one size fits all. But as you get into your particular niche, and that may be property, it may be some sort of casualty line of coverage, you have to really over time become more technical in that particular area. You're also looking for somebody who can have the ability to engage with our insurance brokers. So there's kind of a marketing sales kind of perspective of the job. It isn't just sitting back at the desk waiting for the brokers to bring things to you. There's also an external part of this job. So you're looking for somebody who can engage with a broker and over time build a rapport and hopefully get business opportunities from that broker.
I'm just realizing I could have been a very good underwriter. I was a math major in pre-med, so I have all this science and biology knowledge that I don't use on a day-by-day basis.
Yeah. Well, I mean, for example, I've known somebody with your background that has gone into life science underwriting. And meaning that companies have niches and verticals that's a life science vertical, one of which is of life science. So they underwrite medical products, could be pharmaceuticals, it could be medical devices, both invasive and non-invasive. It could be research and development, et cetera. And they are life science underwriters.
Yeah, no one include me into this career path.
It's not too late.
I'm good. I've already spent enough time doing this.
Yeah, time and money and effort and schooling and everything. Yeah.
And by the way, those underwriters are highly sought after. So they are reality.
There you go. Again, in kindergarten terms, because you skipped over this term, and I think we hear it all the time. But what is an actuary? You said that what is actuarial science? I had a friend in college who wanted to be an actuary at 18 years old, and I had no clue what that was. Yeah. And this person was brilliant, and now they are still brilliant and make a lot of money, I'm sure, and everything. But what is an actuary? How do you work with them in underwriting?
Well, my mother-in-law was an actuary.
Oh, really?
Yeah.
Well, so maybe just clue me in.
There's number one, is there somebody that you want to sit to next to in college when you take a calculus class? That's number one.
That's right.
But after you attend university, they are the ones that I guess the best way to describe it is they're the mathematicians for the insurance companies. They are the ones that study the loss activity, if you will, the loss history of that particular insurance company, generally by product line, by different product lines. So they either the combination of either looking at industry loss data and that carrier's particular claim experience. And they are involved with multiple areas of operations of the insurance company with respects to setting claim reserves. So you see some actuaries are responsible for looking at a whole portfolio of losses and determining, do we believe as an organization mathematically that our loss reserves are adequate? You never want to be under reserved as an insurance company. So we have rating agencies that examine us, for example, AM Best and Standard & Poor's, and they assign ratings to the insurance companies. There's an A, there's A's, there's B's, there's C's, and most carriers want to kind of stay in the A category in order to operate across all kinds of business spectrums. Once you drop into that B category, then you fall off the radar for a lot of companies. They won't do business with you. Part of what AM Best does, Standard & Poor's, is they look at and they challenge your reserves. Do they believe that you have sufficient reserves against your premium writings? That's the job of the actuaries. They are the ones that can use mathematical formulas and predict whether or not they feel like the reserves are adequate or, under reserved or redundant. And I would say that most carriers, at least publicly state, they want to at least be somewhat redundant in their reserves, meaning they believe they're over to a certain percentile over based upon something like COVID-19 that we talked about earlier.
Mhm.
So you have that cushion there where you think, okay, yeah, the actuary might advise we think we're fully reserved, but let's just add on another 10%, and just in case. And that's the job. And then by line of business, they help the underwriters set rates. So they look at lines of coverages, and some of our lines of insurance, the industry supports some rating of that. Excuse me, not rating, but rate analysis. Like, for example, commercial automobile, workers' compensation, and some fire rates are industry. Those kind of rates are learned, or each carrier can look at particular rates and determine and share the rates between companies. There's some lines of insurance like D&O or environmental insurance that are not supported by that method. So actuaries look at the company's results and determine and advise the underwriters. We think within a certain rate range, we'll make money.
Do you interact with them day to day, or is it big reports, or is it more of a call and email back and forth all the time?
My particular job, I'm in charge of the business unit. So I have an actuary that's assigned to my business unit, and we speak weekly. Matter of fact, I have a call later today with them. So we, on a regular basis, we're having discussions about a variety of issues associated with my product line.
I think it's fascinating because there's so many aspects of like the back end of the insurance industry that, Nate and I don't see. We deal with the claims and litigating those claims. So, and we just don't see what goes on behind the scenes and how involved and honestly technical it is. Whereas on our side, I mean, it's technical in a different way, so it's, and I think it's important for attorneys to understand the back end, because then we can do our job a little bit better too. And we understand like what we're telling our claims adjuster, okay, this is your assessed risk. This is, your pure exposure. This is your reasonable settlement range, like what those numbers mean to them. Because on their side, because someone else is also looking at that as well. So I think it's really important to have a better idea of the greater picture.
Yeah, and there's a whole, it depends on the company, but there could be hundreds of actuaries that work for the company. Literally hundreds. Depends upon the size of the insurance company.
Yeah, I hope there's not just one.
Yeah.
It'd be really really hard work.
A lot of stress.
But you'll find there's a head actuary, like there is, like, for example, a CEO of the company. There's generally somebody who has risen to the level of the head actuary of the company. But then there are actuaries assigned, again, by discipline, by underwriting product lines and discipline. And then there are certain actuaries that go into certain areas and try to look at deep into the company's results for going back maybe to the 1930s or 40s. Like, for example, asbestos.
Mm-hmm.
You still see carriers reserve for asbestos exposures, which kind of came out of the 40s and 50s and 60s.
I'm glad you mentioned that, because I did want to touch on this. Being in the environmental space, I mean, what are the big trends that you're seeing as to potential large exposures now or moving forward into the future?
Well, it's not an easy question to answer. A good question, because there's different types of environmental policies. There isn't just like one policy type. Right. There's different policies, different types of exposures we write. But I would answer it by this way, or at least attempt to. For example, the industry, one product in particular is called a contractor's pollution liability policy. And that policy insures a contractor, and it could be for all the operations that the contractor does. So the policy is not specifically tied to one location. It's wherever that contractor goes and works. the policy provides coverage for bodily injury, property damage, and environmental cleanup for what they do at that job site. That policy can be written also on a certain project. Let's say a large construction project. The policy can be written for that project and all the subcontractors on that site. So one of the areas we've been finding recently, and I would say my competitors probably also, is construction defect issues. That seems to be kind of an evolving trend. And I wouldn't even call it a trend. It's been there, but I would say the trend has been that there's been more activity in construction defect and higher level amount of claims for construction defect. And that would typically be post job completed or near job completed, where the building, let's say it's a building and it's being worked on and being renovated, and it's going to be reopened, and now the owner of the property believes that there's a construction defect that's preventing the building from being opened, or they weren't able to get certificate of occupancy because they believe that there's a construction defect allegation. And so, again, kind of looping back to the jurisdictions, if that's in a troubling jurisdiction, and depends upon how mostly the case, I would say the case law in that particular jurisdiction handles construction defects. Some jurisdictions might say, it's assigned to like an administrative judge, and then he or she kicks it out to arbitration. Mm-hmm. And just says, oh, we're not going to tie up the courts on this, calls in all the carriers involved, and it just says, it's a $50 million claim. You guys, you all settle it together, or I'm just going to assign out percentile on it. And depending upon the jurisdiction, there might not be much you can do about it.
Yeah.
So we have a deep eye on that side. The other one of the other products that is available in the insurance industry is pollution legal liability policies, or sometimes referred to as environmental impairment liability policies, or lastly, site pollution. Basically, all those names. It's a policy that's written on a particular location or locations for an insured. So let's say it's a manufacturer, or it's a municipality, or it's a real estate owner. It's written on their properties. And so there is a trend with certain chemicals that have evolved over time. And there is concerns about the chemicals contaminating drinking water. And some of those chemicals are regulated on a state level. Some are not, some are federal, and then some are state and going to be morphing into potentially federal regulation. So as an environmental underwriter, you want to be cognizant of those issues. And some of the policies that you write, there may be evolving standards that might come into play. You might write a policy today, but yet the standard changes over time, and you might be brought into it.
It's interesting. We had there's a place in my town that was like an old paint factory or whatever, and apparently they were dumping the paint out like out the back, and it then seeped into the ground, and then it polluted this little pond area, and it's like a big issue now, but it was like 20 years ago that this was going on, and it's trickling, it still trickles forward today. I think the houses over there had well water, and now they can. And that's the thing. When environmental claims, at least my understanding is that they last for so long, and you might not even know they exist for X amount of time afterwards. So it's just
exactly right. And then your paint manufacturer, let's say they're out of business, there's no one there,
the building's gone, the
building's gone. Or let's say it's not gone, let's say the building's still there, and then time has gone by, years have gone by, and so there's a whole other aspect of our industry where it's called they want to redevelop the property. Mm-hmm. So let's say now the city or wherever it happens to sit says, this is kind of an eyesore. We want to get this, we want to reuse the property, reuse it. And you see that more in the urban core area where, let's repurpose the property. And so, but someone who wants to buy it says, wait a minute, I'm not going to buy that property because there's contaminants on the property. Well, now the municipalities, it's kind of referred to as, the slang as brownfield redevelopment. Mm-hmm. Folks may have heard about that. You can also apply, depends upon the state or the county, the city, what's referred to as the innocent landowner defense, and you need to engage an environmental attorney and do all the paperwork. But basically what the city, the municipality, or the state would say, we'll allow you to redevelop it, and we're going to do due diligence and prove that you never owned this, nor did you once own it, go out of business and morph into another company and come back to own it again. If we can prove all that, we'll give you a get out of jail free card and let you acquire the property, redevelop it, and we'll ensure that you won't get litigated, because you're helping the community, and you're reusing the property.
And that's, see, these are all things you don't learn about. At least we don't learn about as much in law school unless you take the environmental law class, which I don't think I took. And I know we're running out of time here, but I have one last question for you before I let you go. Being in this industry for 35 years, and you've seen, I don't want to say you've seen it all, but you've seen a lot. What advice would you give your younger self now?
I would say younger self would be just continue, just stay very laser focused, to be very technical. You can't beat, as I advise young people, you can never someone can never take away your education. All right. So continue down advanced educational classes, whether that's a postgraduate degree, whether that's strong technical skills, industry designations. Just always continue to pursue those paths.
I think that's great advice.
Excellent.
Yeah. Although sometimes the advice I would give my younger self is to have a little more fun. I think I was too focused, on grades, and I missed out on some things, but.
Well, you're a math major. That just goes part and parcel with.
But that part was easy.
Oh, for you. Yeah, for you.
I majored in Dr. Chang. It was not that hard. Well, thank you so much for coming on, David. Really appreciated talking to you, and you giving us the explaining how underwriting works to kindergartners. And and for all our listeners, if you like what you hear, please like and subscribe to the Defense Never Rests on Apple Podcasts and on YouTube at the Legal Navigator.